when I can only do one deal every 2 years or every year, I need to like watch every dollar. Like in some ways, I'm more careful than they are. Even though they have more experience and they've learned more, they're like, in some ways, I find them that they're less selective. They've kind of almost resigned themselves that they're gonna not make money on every deal, and that's okay.
Welcome to the Path to Passive podcast, where we talk about building wealth and empowering lifestyle through commercial real estate investing for tech professionals. I always wish that other tech professionals reaching financial freedom had documented their journey along the way, so I'm doing it for the rest of us. Join us as we explore stories, many failures, and lessons learned along the way. I hope you enjoy and subscribe. Yeah, man, that in mind, the thing that I really just wanted to kick off for today and really just hear a little bit more about from you is that 14 limited partner investments, right? 14 LPs. How did you get there? Tell me a little bit about, what was the process to getting that many? Did you have a goal in mind, or was it just, you just kept on stacking those?
Well, when I first got into this, I came across the concept of investing as a passive investor in apartments around 2015. And I soon learned that, the typical minimum investment is $50,000. And that was like exactly all I had at that time. So in the beginning, it was a simple question of, well, I can do one and then I can wait and hopefully make more money. In fact, I was even a little discouraged, like maybe I can't afford to do this. The truth is, if you only have, you shouldn't invest, your life savings into these things because the deals are risky. So, I decided I had that much to invest, but then I had a realistic plan. I did some projections of my income and how, other things would work out in my income and expenses. And I realized, okay, even though I can only afford to do one now, I think I'm going to get into this game because over the next 5 to 10 years, realistically, I should be able to make many more investments. And it did work out. I said, as long as these investments go well and my income continues where it is and it continues to increase, I should be able to do more. So I did one the first year. I did 2 the second year, and then I had to pause for a while. And then as time went on, I had a couple sales. So I had a lot of extra cash. I had some things had gone well at my W-2 job. So I accumulated more cash as time went on. And it is a little shocking now that I was managed to scrape. I've actually been in 15. I think when I told you 14, I might have left out the most recent one. But nice. To have invested in multifamily 15 times, it's almost a little funny to think back in 2015 that I hesitated to spend a couple $1,000s to join an educational program where I could learn how to do this, when I think about how much money I have invested in this business now. So it was a slow process. I think around 2021 is when I had a couple sales, so I had extra cash, and then I have one single rental property I own myself that I refinanced to, and I was finally comfortable enough to start maybe taking more risks. And I had a property that I owned had quite a bit of equity in, and I finally said, okay, I think I understand this business enough that I'm going to refinance that. And that was 2021 when interest rates were very low. So I tapped a bunch of equity, had more money to do some more deals. So I never had a plan of how many I was going to do. It was going to be as many as possible. And that's where I am now.
Yeah, man, that's Paul. It's super cool. Really. I think it's one of those things, you have a background in engineering as well. I want to talk more about that and how, some of that applies to the thinking processes. But to the point of, starting with 1 and then 2 and then 3, going from 2015 to what you were just talking about, 2020, 21, and, now in 2024, 9 years later, right? Did you find that to be pretty true that, like you're saying, invested the first couple thousand, to just getting that education, right? And then seeing some of the results sort of snowball? Was that how you were seeing things picking up momentum, or was it just maybe until, what point did it start to snowball? I guess is my question.
I would say when I got over the hump of making the initial investment just to join the educational program, when I first went to a seminar and it was offered to me, I said, is this really worth it? There's so much information out there for free. Do you really have to pay somebody to teach you these things? And it's true that all the information is out there. You can go on Google and YouTube, and there's no secrets that nobody knows about. The difference is joining a program where it's condensed for you and easy to understand and easily digestible. And then you're also surrounded by other students who are already experienced and you can learn from them. And even somebody in the program had told me it was almost like, for them, it was like a gym membership or paying for a personal trainer. Once you make that commitment, you're gonna get your money's worth over the following year, and you're definitely gonna go. And I viewed it as sort of an insurance policy to pay a couple $1,000s. If it keeps me out of one bad deal, then I would get my money back. So once I was in the program and I was surrounded by other like-minded people that were investing in multifamily, then I realized that it definitely paid off. And I haven't really spent a whole lot more money on mentoring. I know there's other things available, but as a limited partner, I don't really want to be doing my own deals. So I haven't really invested that much more in my education since then. I think that, so for me, it was a modest amount, and it absolutely paid off, because once I was in it, and there was no question of should I do this. I'm definitely doing it. It's just a question of how and when should I invest and which deals should I choose, and how much money do I really want to put into this. And that number grew as time went on and I got more comfortable. So I moved slowly. When you make that snowball analogy, it took probably, it was maybe 2 or 3 years before I really said, okay, I'm comfortable. I'm going to put more money into this. And then that was how long it took to come up with that amount of money anyway. So it was kind of a mixture of things. It took me a couple of years to say, okay, I'm going to put a significant amount of my net worth into this asset class. And now I have that amount to invest available to do it. So it was kind of a gradual start, and it did grow. It started gaining more momentum after a couple of years.
Yeah, super cool. I love the analogy back to your point about it being like that gym membership. I mean, it is a place where you're developing those skills, albeit a different kind of muscle, right? If you will, that skill of investing muscle. From that first, getting to learning until you said like it was like 3 years later when I was after your first investment to start to we'll call it save up more for the next one 3 years later. What kept you focused? Was it staying in a mentoring type of program, or just staying in a group of like-minded people? Is that what kept you focused, or how did you stay focused into thinking, okay, 3 years later I'm going to make another investment?
I think because it was, first of all, I was committed to making this, to investing my money wisely, and the concept of making income making passive income without working. I mean, once I realized that was possible, I said, all right, I'm going to keep doing this, but I also need to stay plugged in with people that are in this business, because I need to invest in the right deals. There's always risk in investing in real estate. And if you didn't know that before, the last year or so has proven the risks. I mean, those risks were always there. They're just finally showing now with foreclosures or deals that are not paying any money, or selling for a loss, or having capital calls just to stay afloat. So I stayed focused because I was always aware that those risks were out there. And I didn't really, as a retail investor, I couldn't afford to lose money. I think when maybe large institutional investors buy hundreds of properties knowing that a couple of them might not pan out, I need to watch every dollar. So it was critical to me that I need to understand exactly how this business works. And if that means, staying a member of this program and going to the events and networking with the other students, that was well worth that time and energy.
Awesome. Yeah. So super, super key perspective, right? It was not only a way to continue to develop skills, but it was a way for you to also sort of keep a beat on, the environment. I don't want to use it general terms like market.
Yeah, I think you got to kind of keep your finger on the pulse of what's going on, because things that worked a couple of years ago aren't working anymore. People would buy a property, make a few cosmetic improvements, and then cap rates would continue to go down, and you almost couldn't lose. And today, people are doing different types of loans. Around 2021, they were buying properties with bridge loans and floating rate loans. And I understood that was, in a seller's market, that was the only way that the buyer could be competitive, to take a high leverage loan to be, with a floating rate. And I don't think if I hadn't seen that progression, I don't think I would have understood the risks involved. And many of those deals today are in trouble. If some of them have been foreclosed already, and so it was important to me to understand like what is, you know, I mean, I'm only talking about the debt. I mean, that's such a big part of it. But there's so many other things. Like when somebody says they're buying a property for $80,000 a door, a couple of years ago that was insane, and maybe today that's a good price. So that's why I need to stay plugged in to know whether this is a good deal. I mean, in 2016, maybe a good price was 40 or 50,000 a door, and 3 years later, if I hadn't stayed up to date, and somebody showed me a deal that they were buying for 90 a door, I would have said, well, that's crazy. I'm not, I mean, and then I would have realized, no, that is still a good deal today because the numbers work. Rents have gone up, and so you still have to stay up to date with what's going on.
There's so much goodness in here. I want to pull the thread on a bit. I want to say that, or I wanted to ask. I know we're talking at this point years ago, like you're saying, starting 2015, 16, 17, 18. What were, if you can remember, some of the questions and types of things that you were asking, conversations you were having to really get educated? You're talking about, looking at, even at that point, what history was over the last couple of years, right? But also, asking other members in your, in the group how, what they were doing. So do you remember what kind of questions you were asking so that you could kind of extract the knowledge you needed to feel comfortable to do the analysis, understand things as, where you are now, et cetera?
Yeah, well, in the beginning, the first question was, I mean, when you're at a seminar or watching like a webinar or something, and somebody talks about how you can invest in a multifamily deal and own a piece of this property and just collect income after that, and then one day they're going to sell the property and you're going to get a big fat check. The first question is asking other people, is that true? Have you really done that before? Finding other passive investors, and so that was who I looked for at first. I mean, yes, you want to meet the people doing the deals because ultimately you might invest with them someday. But my first question was, all right, well, who are the investors here? I want to talk to them. And some of them that had been around for several years even carried around a book or a paper that showed, hey, these are all the deals I've invested in and these are the returns I've made. I'm like, okay, that's exactly what I'm looking for. And, maybe even some of them didn't go that well, but the market was very good, so that they were hardly losing anything at that, between the years of, say, 2012 to 2016 or 17 or 18. It was almost all home runs or doubles, or if somebody hit a single, it was almost a disappointment. So yeah, absolutely finding the other people who have done what I was hoping to do, and just like, hey, is this real? And if so, how did you pick? How did you find the sponsors that you wanted to invest with? How did you pick the right ones? So I got some tips on, all right, well, how do you vet out the sponsor? How do you decide where you're going to invest? And then when you look at the deal, how do you decide that this is a good deal versus that one? Because once you start networking and meeting sponsors, you get so many opportunities sent to you every day, you can't even keep up with them. So the challenge is, when you have good deal flow, you have to pick which ones you're going to invest in.
I remember the moment when I was at, some of the different conferences too. And I think even I have a different sort of path, but landing at a conference and hearing more and more and more, getting educated about, oh, you can do that? Like, can you really? And getting, questions from colleagues or whoever, like, that kind of sounds like a scam, right? which is, what's that?
Too good to be true.
Exactly. So it sounds like, you had that sort of, I don't know what to call it, maybe an epiphany, like you're saying, of, oh, you can do that. And then talking to others to sort of validate that that's a thing as well. Was this a really big aha for you? When you first were like, wow, you can really do this?
I think the real aha was probably before I got out there and started attending seminars. Originally, I just started reading about real estate at home, and whether it was websites or books and things. And then so that was where I came into the concept of how you can make money in real estate. You buy a property and you can make money via, cash flow or appreciation or amortization or tax benefit. There's like five, there's different acronyms people throw out there. Like there's 6 ways to make money in real estate. And that was like, just reading that stuff at home was like, wow, if you can find a good property, this is what I should be doing. And I had been a landlord before. Like I had been a small landlord. I owned a single rental property for several years before that. And I wasn't making a whole lot of money just because of kind of an accidental landlord. I didn't really do it properly. I still own that property today, actually. But when I started reading up on how do people really make money at this, I had so many aha moments like, oh, this is what I should have done. I should have, bought this property and not that property. I should have kept an eye on this number or that. So all the major revelations happened at home. And then, but some of the things I read about said you've got to get out there and, network with your local landlord group or your local real estate investing clubs. And when I went out there and found people real who were doing it instead of just reading about it on paper, it was like, I mean, I had already had the revelation, but now it felt good to know that other people are really doing this. So it's kind of a two-step process, I guess.
Validating the thesis, validating going to into practicality.
And it's happening today even.
So what you're saying is, in your case, being that accidental landlord as well, you don't have to have a bunch of single families. You don't have to be an expert at Airbnb. You don't have to, have a long-term, whatever it is. And you can go into learning about the, asset of multifamily, but also just go straight into passive investing.
Yeah, you can. I mean, I think for me, it was becoming a landlord kind of opened the door to investing in real estate in general for me. I may never have discovered it otherwise. So even though that first rental property was not a huge success, it got my foot in the door into real estate, and anything else, any other success I've had after that was because of that first property. But if somebody were to discover it on their own, maybe they have a friend who's doing it, then you can totally skip buying properties and being a landlord or owning an Airbnb. All those things are not passive income. Sometimes they get billed as passive income, but it all takes some work. So if somebody were interested in investing in real estate without doing a whole lot of work, investing in as a limited partner is the way to go. Now that might not make a good soundbite because there is a whole lot of work up front to learn how to do it properly. But once you're a sophisticated investor and you find a good deal, then it becomes passive.
For sure. I was going to ask you that question, right out the gate, we came hot, and I'll have other episodes, and I have some already where we talk about, general partners, GP, limited partners, LP, and, the 14 or 15 now LPs investments you have. Talk a little bit about just, quickly around active versus passive investing. And then, of course, that'll be a lead into, you said that you haven't gone into doing your quote unquote own deals yet, meaning active deals. I'd love to understand, like why not?
Well, I mean, when I invest in these deals, I know as a limited partner, I'm not doing any work, which implies that somebody else is making money for me. So the general partner who's finding the deal, making an offer, putting the deal together, acquiring the property, and then, of course, doing all the operations for the several years that we own the property, they get a bigger cut of the deal because they're the one doing all the work. As an investor, I'm just more like a silent partner putting up money to help the deal happen. And those people can do really well on one or two properties. They can put, a large 6 or sometimes 7-figure check in their bank account. So naturally, that's way more appealing than somebody who might make, if somebody invests $50,000 and you make, say, 8% cash flow, that's $4,000 a year. I mean, it's a nice little, that might pay one or two of your bills, but you're not going to quit your job on something like that. Somebody who's willing to do all the work of buying a 100-unit multifamily property can probably make enough money that maybe they can stop doing a W-2 job. So that appeals to much more people, because if you're going to put in the effort anyway, why not do the whole thing and make all the money and have control, versus someone like me who's basically trusting their money with somebody else because I have other things. I've got a regular W-2 job that keeps me busy. So there is a big difference. There's no versus being an active or passive investor. There's not a whole lot of in between. I mean, if there were more intermediate steps in between, maybe one day I could make that jump. But I'd rather focus on my career where I make the money to invest rather than take on a whole new career. I work in a business outside of real estate now. I mean, as an engineer, I work with a lot of numbers and dollars, and I think some of those skills have translated well into becoming an investor. But it would be a totally new career for me to decide to start buying 100-unit commercial properties. And for those people, maybe they already work in real estate. Maybe they have a job they don't like. Maybe they just know that they'd be good at it. A lot of people want to do that. And sometimes I think, though, that too many people want to do that, and you end up with 100 people chasing the same deal. And I think if there were fewer people competing for these properties, the investment returns would be a lot better. And other people could just invest in them, and we'd all make more money as investors if they weren't being so aggressive trying to take down a deal. So, I mean, the reason I'm not interested, I kind of hinted at it. It's just a totally new career for me, and I'm already working in a business that I like, and it takes more than enough time and energy already. I don't really want to take on a second career. So maybe on the weekends, I'll go to a real estate event, and that's the time I put into this. So it's not a full-time job for me at all. It's almost more like a hobby that I, sometimes look at an investment offering, or I'll go to a networking event, listen to a podcast or watch a webinar or something like that. I find that's more than enough for me. I like to keep it to a level that it stays interesting. I don't want to turn it into another job where I don't enjoy it.
I really appreciate that you also mentioned that it does take a bunch of effort up front, right? And just to touch on a couple things that you mentioned, you talked about the benefits that it is for yourself as a limited partner into deals, and the benefits for the general partners. There's benefits, but just like anything you talked about in all investments, there's risk as well, right? And so, the risk they take on is a lot of liability as general partners, sort of, aiming the ship and doing all the operations on it, and really being quote unquote active side. And it might be enough, income for them to, quit their W-2 or wherever they are in their journey, but the ability to really find a good team that has a great track record, et cetera, and be a silent partner, and also getting returns so that you can continue to focus on what's more interesting. Or to your point, you're an engineer and you're at a place where you really enjoy it. It makes a lot of sense too. And so it's only too good to be true to think, oh, well, I'm just going to put in some money and other people will do things for me. There is work that has to happen up front. And one of the things I really appreciate about you too is that, you know your numbers and the details well, which I absolutely love. This is a podcast for tech professionals, and we have to get into all of the data everywhere, much like yourself. What is some of the work, that you're speaking about? So what are the things that people would have to know before they would go and even consider in spending investing the 50,000 or so into a deal?
So if somebody decides that, if somebody has a little bit of extra cash that they can, that they can invest, that they can tie up into something that's not liquid, and they decide they think they want to be a real estate investor, and they think, okay, well, where, should I invest in multifamily? I guess maybe the first step is, should I do the work myself? Should I buy rental properties or flip houses or Airbnbs, or should I just become a limited partner and let other people do the work? And once you decide to pick the LP path, the first thing is, okay, well, should I pick an asset class? Should I only invest in multifamily, or maybe a couple? Maybe you study a couple of them first to see which one was more appealing to you. They all have their pros and cons. Multifamily, people sell because it's one of those, basic needs that never really goes away, versus renting out maybe a warehouse, which can go up and down with the economy, or retail, which is, subject to, online shopping and things. I mean, there's every asset class has pros and cons. So maybe you pick one that appeals to you first. And then the next thing is, well, where can I find the general partners, the sponsors that are doing this? I don't know how somebody would have discovered this without somebody else telling them about it. But so maybe you ask the person who's already more experienced, well, okay, so how do I find the general partners? You find some people that are, that are good at what they do, have a good track record. And, first thing is, are they good at it? Are they experienced? Have they done this before? Have they done these types of deals before? And also, personally, can you trust this person with your money? Then you kind of need both. There's plenty of, honest people out there that are not that good, and you shouldn't trust them with their money. And there's people out there who may be very good, but maybe you don't have a good feeling about writing them a $50,000 check. See, once you invest in this deal, first thing is, it's not really liquid. It's very hard to get out. You can't just call them up and say you need your money back. So there are sometimes ways to exit, but it's not easy. And chances are you might not get all your money back. You might have to sell at a discount. And it's just not a simple process. So the first thing is, can you tie up this money for several years? And then second, is this a person you trust with your money? Do you like them? Do you trust them? Talk to other people that have invested with them before and see what they think. Talk to people you trust too. I think it probably just really boils down to networking. You need to find other people that have already done this and talk to as many people as you can and form an opinion on your own, because sometimes you meet someone who has different criteria than you do, and they're going to say, oh, I would definitely invest with this guy. And maybe you get to know them and you think, I don't know, I don't think he's right for me. And maybe you just meet other people and you form an opinion on that. So I would say meet as many people as you can, and eventually you come to your own conclusion on where you'd like to invest and what other limited partners, whose judgment do you trust versus others who have different criteria, and maybe you shouldn't invest the way they do. Some people invest because there's very high tax benefits to investing in real estate, and some people, they invest because they need to show, I need depreciation before the year's over, so they don't even think about whether it's a good deal. If you're trying to make money and you don't care as much about tax benefits, then maybe don't invest. You shouldn't take their advice as much. Somebody who has the same, you got to find people that have the same goals as you do. So, in one word, just networking, find people that want the same things you do and learn from them. So maybe then you start narrowing it down your list to sponsors where you think you'd like to invest with. And you should meet as many as possible because, first of all, you're not going to like all of them. So that way you narrow it down to the list of sponsors you like. But also, in any competitive market, they're not always going to have a deal. So you might find a sponsor that is exactly what you're looking for, and it could be 6 months before they have an investment opportunity for you. So that's another reason why you'd want to invest with, find multiple sponsors. And then one other reason is just diversification. Even if you find the perfect sponsor, you really shouldn't put all your money in one place with one person in one deal. So you should find, depending on how much money you have, of course. I've heard people make the argument that, maybe you should invest more than 5% of your money with one sponsor. Now, if you don't have $1 million, if you have $1 million, then that means you're doing 20 deals and all with 20 different sponsors. If you have $100,000, then you should definitely diversify. Do 2 deals with 2 different sponsors, but the 5% rule is not going to work. So I would say find sponsors you like, and then after that, and this is a kind of a parallel thing, you can do this in parallel. You need to understand the asset class well enough, and this is where the study at home comes in, maybe a little bit less networking, but you need to understand these investments well enough you can evaluate a deal. When somebody shows you a deal, you need to be able to say, is this something I want to invest in? My opinion is, if you look at 3 to 5 deals, and there needs to be a couple that stand out as better than the others. If they all look the same to you, then my opinion is you don't really. I don't think you're sophisticated enough. I don't think you've learned enough yet. If you can't see the difference in what makes one deal better than another, then I think you need to keep learning. And I say move slowly because there are always more deals out there. You never really feel that you have to jump on a deal. You're going to miss the opportunity of a lifetime. There's always going to be more. Now, if somebody has been on the fence for a year or 2 years, yes, eventually you got to just stop sticking your toe in and just jump in and do it. But I waited a couple months. I joined the mentoring program in February of the year that I joined, and I made my first investment in July. So it took me 5 months before I decided I was ready. Maybe you don't need 5 months, but I would, other people I've heard, they join and they're immediately throwing $500,000 into 10 different investments in the first 2 months. I think, geez, how could you possibly have done enough due diligence on all these deals? I guess to summarize what you asked, my response to what you asked, first thing, decide where you're going to invest. Second, find people that are doing it on both sides. Find people that are doing the same investments so you can learn from them, and then find sponsors so you can decide whether to invest with them. And then the third thing is, it's kind of 2A and 2B because you got to do this at the same time. The third thing, though, is learn about the asset class so you can understand what's a good deal and what isn't.
Broken down like an engineer. I absolutely love it, Paul.
I like doing everything in steps, thinking of everything in terms of steps. I like flow chart. I don't actually draw flow charts, but I have them in my head sometimes.
You're drawing all the flow. You're like Minority Report, Tom Cruise, moving things around in your brain. I see you. I think that is an absolute masterclass, my friend. That is so good. I've spent probably the first 10 couple episodes or so of this podcast just really harping on criteria, sort of building on market, building on sponsorship team, and then building on deal, right? And there's variables, quote unquote ducks in a row, right? You have to have these things line up. One of the things that I heard early on in the investing career, which I absolutely love, is it's like when money meets experience, experience gets the money, and money gets the experience.
I think everybody has some expensive lessons learned in their career, And it's easy to go back and say, I shouldn't have done this, I shouldn't have done that. But you learned. And then, I mean, hopefully you don't make the same mistake again. But, if you hadn't made that mistake earlier, maybe you would have made a worse mistake later. I'm glad that it took me, I think it was kind of a silver lining that I didn't have a whole lot of money when I first started out. So if I invested in a weak deal, I only had that much at risk, versus if I had $1 million and I could have invested in 20 deals, I might have done it all in 1 year and I wouldn't have learned. And I mean, several years ago, the market was so hot, I probably would have won anyway. But I'm glad that I had time to get more sophisticated as an investor, so that by the time I had more money years later, I think I was a lot more discerning in where I wanted to invest.
For sure. And I deal in flow charts and in quotes. Those are my currency. So we're in good company. The other one is, a no deal is better than a bad deal.
Oh, yeah.
Right.
Absolutely. I mean, that's, as an investor, and I'll tell you, so typically with these multifamily properties, you might hold them for 3 to 5 years. And when the market was really insane, people flipped their properties in 2 years and doubled their money, but that's not normal. So you hold these properties for 3 to 5 years. Now that I've been at it for about 8 years, I've seen the full cycle of a number of deals. And there's quite a few that, I remember looking at that one and I didn't invest in it and I hear it went badly. I'm like, well, I'm glad I missed that one. And then there's others that have gone really well. And I'm like, I should have invested in that one. But there's quite a few that they didn't go well. And at the time, I found it appealing, and maybe there was some risk I didn't see, or I saw the risk, but I didn't think it would be as bad. So I'm very glad there's certain deals I've been invested in. I think there's general partners that say the same thing, that when they make an offer and they lose, it's disappointing, no doubt. But it's better than overpaying and ending up with a bad deal than spending 3 or 5 or 7 years trying to turn a bad deal around.
Life lessons on that one. Life lessons. If you have your criteria, be firm in that. And if it doesn't fit your deal box, there will be another, right? So when were you mainly, so you're talking about being in a W-2 that you enjoy. I'm in the same boat too, in a lot of ways. But my question is around, were you investing for cash flow as primary for your criteria?
It was primary in the sense that if a deal cash flowed, I viewed it as safer. It's not that I needed the cash flow like a retiree who's on a fixed income needs to make a certain amount of money per month. So it's not, I didn't need the cash flow for spending purposes. I wanted deals that would cash flow because I felt that they would be safer. You can really, the deals that have high appreciation is where people get rich, but it's riskier. And so, in the beginning, it was actually, and I might not have defined the criteria that well in the beginning. So my very first deal I invested in, it was a really deep value add, and the sponsor had warned us that there probably will not be any cash flow for at least a year. And I was fine. I didn't need the cash flow. And it ended up being more than a year. And I think my advice to a new investor now is to invest in a deal that does have good cash flow, because it's a good morale booster when you get that check or payment every 3 months or 6 months, or some sponsors pay out every month. But for my first investment to not pay anything for about 18 months, and I understood the risks, but maybe somebody else who is a little bit more unsure about it, it probably feels better to get those payments up front. So as time went on, I think I developed my criteria a little bit better. And once I could afford to do multiple deals, I started looking at it like the way that people have an investment portfolio with asset allocations, and they do 60% stocks and 40% bonds, whatever they do. I decided, all right, I'm going to have, a certain amount of deals are going to be safe cash flowing deals. Some of them are going to be heavy value adds, which I think will make me a lot more money, but they're riskier. So I tried to, all right, I'm going to do, if I have 5 deals, 3 of them are going to cash flow, 2 of them are going to be appreciation. And then I started, when there were other things happening, when people were doing bridge loans, which I view as more risky, I didn't avoid them altogether, but I kept it to a minimum. I kind of did the same thing. I said, all right, I'm only going to do 1 deal with a bridge loan, and the other ones are going to be safe, fixed debt, long-term, and those are going to be safer. So, even though I'm not looking for cash flow, I like it better. And then I just still don't always, I don't have one strict criterion for every deal. It's more when you look at the whole. Like I want at least 6 of them to be safe, 2 of them to be, a little bit more risky, and maybe 2 of them can be very risky, something like that.
Yeah, outstanding. Looking at it from that big picture, that's exactly where I was. Had wanted to ask some questions, but you answered all of those, so that I appreciate that, because that's exactly the point, right? I wasn't as defined there either. It was like, all right, let me learn about the asset class. Let me get in. Let me start. Like, when do I start seeing returns on this quote unquote, return on investment, et cetera? And the point of getting cash flow or getting, those checks does mean that it's generating income into the point where it's able to start paying back the investors, which is what you are, right? But looking at the portfolio view of having some that are bond-like, reliable, but may not have the most, and on the other end of the spectrum, a year, or if you go look and say, I can wait like a year or two in a development project and get it like 2 or 3x, is on the other end completely, but certainly. So 15, sounds like three of them or so went full cycle. How did you keep track of these over time? I've heard from others in the group, it's like, we gotta go talk to Paul to see how he does these things. So local celebrity on our hands, but I'd love
It was easy in the beginning when there was only one deal, because I really looked at all the monthly. So the sponsors, they send out a monthly report. If they're good, they do. And I've picked good sponsors that are good at communication. I've heard other stories where they have no idea what's going on in their investment, and I don't think that's good business. But so I get a monthly report. You see the financials, the profit and loss, the income and expenses. So the very first deal, I made a spreadsheet of like pretty much every number. I just wanted to look at it. And I even made it a point to ask the sponsor a question every month. And as time went on, I stopped doing that as I got more experienced. I also think that I don't think, unless it's a serious issue, I don't think you should be, peppering your sponsor every single month. You don't want to be like a high maintenance investor. So yeah, in the beginning, I kept track of every number. And then so I could be like, oh, wow, the delinquency went down this month, or how come we had a big water bill? And I didn't always ask every question, but it was just more like personal. So I could learn like, what are the things that are, what are the significant expenses to keep track of? Insurance is this much, and now taxes are going up that much the following year. So initially it was every number. Once I started doing a couple deals, that no longer became realistic. Well, I could have, but it just took a lot more time. And once I had more experience, I was like, I don't need to look at every number anymore. So then I started looking at, okay, let's look at the numbers, and let's look at the NOI, the net income, net operating income, and let's just make sure that we're making money, that we're not like that, that it's higher than the debt service, and make sure income's higher than expenses, and that's all. So the spreadsheet got a lot less sophisticated as time went on. Once I was in 5 or more deals, I realized I'm not keeping track of every deal anymore. I'm going to keep track of how much money I'm making. So now it's just a simple simple spreadsheet with a couple columns for every deal and a date of how much money I made. And I can see, okay, I made, so every year I can look at how much I'm making in cash flow and distributions. And then when the deal sells, I can get a total of how much I've made on that entire deal. So now it's just a simple spreadsheet of every deal and how much I'm getting per quarter or per month or whatever it is. When I look at my bank account once a month or whatever is when I update it. And today things have been a little, the distribution, the cash flow has been a little light. So it's very easy to update the spreadsheet when you're not getting as many payments anymore.
Sure. But we're in the game.
Yeah. So for an engineer, I don't know that anybody would be too impressed with the spreadsheets, with my spreadsheet skills today. It's just a bunch of addition and division. I don't really have any, the whole pivot tables and stuff like that. It's not, and macros. I'm not doing anything too fancy right now, but I do keep track of what I'm making. I'm surprised when I share that with other people and they have no idea what they're making, because in some cases they have way more money invested in this than I do. And I thought, well, you don't even care. It's, and I think I had made a little hint earlier about when you're meeting other limited partners and you want to try to learn from them, you really need to identify who has the same investment criteria as you, because some people have way more money and they've made way more investments, and you might immediately think, oh, this is someone I'm going to learn from. He's invested in 50 deals or 100 deals. And as you get to know them better, you think, yeah, that they're not even that strict with it. Do they just accept that some of them aren't going to be good? When I can only do one deal every 2 years or every year, I need to watch every dollar. In some ways, I'm more careful than they are. Even though they have more experience and they've learned more, they're in some ways I find them that they're less selective. They've kind of almost resigned themselves that they're gonna not make money on every deal, and that's okay.
You'll find them. I agree. You'll find them, and to that end, it's such a sort of plus one feather in the cap for education, right? Knowing what you need to know so that you can make decisions, not sitting on the fence for the year plus, like you're saying. And that education is a massive de-risker as well, but you have to go out there with it. Yeah, it's interesting. The things that you think might be true aren't always true, which is those that maybe have a bunch more money. Maybe they made it somewhere else and their investing muscle isn't as well, or they're just trusting others on that scale and they're just, spending quicker, so to speak. Trust factors. So do you, my brain goes to this. I only have a couple of LPs. I've got some rentals as well for me, sort of on a different path. But what I wanted to ask is, being heavy into, software and automation and things like that. Honestly, I'd have to take some time to put together a spreadsheet myself, but I'm also thinking, what software could I use that would help me out with this? Do you use any types of software that helps you out with tracking things, maybe more from a personal finance perspective, or is it just looking at things on a more manual side right now, just being organized?
I find that things are simple enough for me that I can just keep it on an Excel spreadsheet. Or actually, it's not even Excel. I'm not even going to name drop the company. I think I've got one of them on a Google Sheets. But
nice.
Sometimes I think, is there some way I can improve this process? And I just find, I don't know. I mean, it's simple enough so far that, is it really worth the effort to try to make to do something better? And I think when I'm only when I'm only a limited partner, I'm not keeping as track of as many metrics as somebody who's operating a deal is. And maybe they have they either have some automated system or they have virtual assistants doing work for them. I haven't found that there's enough of that for me to do. I don't know how I can look at, even when there's a new offering, I want to read it myself. I want to look at some of the numbers myself. So I don't know that I can recommend any interesting labor saving tools.
Yeah, no problem. It does have to be at a certain place before you look at optimizing. I agree with you. I mean, I can appreciate that for sure. And I wanted to ask, are these, some talk to colleagues and I talk through, a lot of this, but also questions inevitably come up like, do I invest through, my name alone? Do I set up an LLC, or do I do anything like those types of things? Any answers? This is all educational. This is nothing, no legal advice, all the stuff. But just wondering, what opinion do you have about that?
Yeah, what I've wondered is, why is that such a common question? Where do people get the idea that they should do that? Because they do ask, hey, should I set up an LLC? And I mean, the easy answer is I haven't done that. So without giving other people advice, I haven't found a reason. Every time I research it, I never find a compelling reason to do it myself. There could be personal reasons why somebody should do it. There could be, if you own other businesses and you like to keep everything separate, it is important not to commingle funds and make sure everything's kept separate. Keep your personal expenses and income separate from business income. But as a W-2 employee, without any, I don't have like a business where I could be sued or any significant liability over anybody. Some people work in professions where they might have high liability and they have some reason that they need to really keep all their business assets separate. I haven't found a compelling reason to do it myself. And what I've noticed is that it's unfortunate when it comes to like asset protection. that the people that are most skilled to talk about it are asset protection attorneys. So of course they're going to tell you to set up an LLC.
Right.
I would love to talk to like a plaintiff attorney who's used to suing people and say, hey, is there any value in an LLC? I mean, I want to hear what they have to say about this.
I'll write that down.
Tell me about a story where somebody did something really bad and they turned out to be invincible because they set up an LLC last year. I mean,
yeah.
I don't really, sometimes I feel like I see these things marketed like just set up, just, throw everything in an LLC and then you're shielded. It doesn't seem believable to me. So I think I've expressed my opinion without actually giving any legal advice here. So, I'd encourage people to look into it some more. I don't see a whole lot of value in it. I don't think there's any tax benefit. I mean, again, without giving literal tax advice, I haven't seen any tax reason to do it. I think people do it for asset protection more.
Same. I'm of the same mind here, and I've gotten different answers from different attorneys as well. So the sort of long story short is go talk to your own attorneys and tax people.
Yeah, I mean, everybody's got a personal situation. If they own a side business, if you're married or not married, if you one day stand to inherit something from a relative. I mean, there's just everyone's situation so different that it might make sense for some people.
Yeah, cool. So we touched on this a little bit about maintaining W-2 and doing the LP route. It sounds like you're pretty for it because you like the path. You like being an engineer and doing this role, but keeping real estate in arm's length enough or involved enough, any way you want to look at it, so that it's interesting. But the path of W-2 LP. There is a path for it. It's working out for you. And if those are super passionate about learning everything they can to go and GP, they can do that as well.
Yeah, I think that it's a perfectly good path to not learn a whole new career. I think for some people, there's people that make enough money at their W-2 job that it just doesn't really, it's not a good use of their time to learn this other business. Even though ultimately you might make a lot of money, I think that there'd be a high opportunity cost in giving up that. If you're making like a mid 6-figure income, you're an executive at a big company, or you work at a tech company and you own a piece of it or something. I don't know. I mean, it would take many years to make up that income in real estate. So you'd have to either really hate it, or maybe there's just some reason where you don't think you're going to make that you're in some business that's about to go obsolete, and 5 years from now you're starting to prepare for an alternate career. I could see something like that. But for most people, I think it makes sense to keep doing what you're doing.
I agree, and it's almost a weird conversation to have, because there's a lot of people who are like a real estate and they want to quit their job and get into real estate and do that whole sort of dream thing. But there's a really good path, like you said, to stay W-2 and just keep on investing like you're doing as well. Just keep rolling that over and over and over.
Yeah. I mean, I think there's a certain type of person that has that entrepreneurial spirit that would be miserable working in a cubicle farm for a long period of time. But those people probably don't have that type of career anyway. So it's kind of there's definitely certain types of people that should go off on their own versus working for a big company. But I think there's others that are probably better off not doing that. I mean, should everybody be a business owner, or some people are better off as employees, for whether it's a matter of desire or skill, or it's just it's a different type of personality, I think.
I want to be conscious for time here. And so it's sort of 2 rapid fire questions. The time has gone by super fast for us, as it does. Is what do you do? What does your W-2 look like? We've touched on it a couple of times. Engineer, we talked about spreadsheets, etc. What do you think the 1, 2, 3 skills are that you've had that you've applied to investing that has made you a better investor?
So I work for a large construction firm in estimating. So I work on bids. My company sees an opportunity and we put together a proposal to the customer. How much will it cost us to build this project, and what should our price be? It's not too different from somebody's eyeing a multifamily property and underwriting it and coming up with how much they want to offer on the property. So I look at an opportunity, I identify the risks, try to put a dollar value to it, ultimately come up with the price that we're going to offer to our customer. I mean, we call it estimating. To me, it's underwriting. I mean, it's the same thing. You're making cost projections over a 3 to 5 year construction project. which is the same time frame that you might own a commercial property. So identifying risks, working with numbers, and quantifying actual costs versus potential costs, and deciding, how much something will end up costing. I think there's quite a few parallels to it, and working with numbers and realizing that you're not going to get every number correct, but you need to be close enough so that the project is still profitable, and also knowing that the best opportunity is often the one that you miss. We spend quite a bit of time pursuing a project, and we make a bid, and sometimes we're not even close, and our competitor, we think that, we like to think they're going to take a bath on the project and they won't be around next time because they totally undercut us on price. And it's the same thing. Sometimes a couple of years later, you hear that project's not going so well, and you think, well, I'm glad we didn't win that one.
Yeah. Yep. Awesome. And then just to close out, those that are looking to do their first or second, investing, or let me rephrase, since you touched a lot on that. What are some of the things you wish you knew when you started?
When I started, I should have maybe understood the risks a little bit better. It was hard to do because the market had such a tailwind to it that when you ask people for like war stories of the time they lost money, there were very few of them. I think today, somebody starting out, ask somebody about the deal where they lost money, because they're going to have there's way more stories out there now. So that would be, even though it was harder to find then, that would be the advice to somebody starting today. It's find out about the deals that haven't gone so well and find out how you can avoid them. Because there are still good deals out there. There's still money to be made as an investor. There always is. Sometimes it's just harder to find than others is the only way is how I would make the distinction. So I wish I had understood the risks a little bit better. And I've been fortunate. I have not lost money still. I've heard stories about people that have. So I'm crossing my fingers, knock on wood, that continues. I'd like to think it was partially due to my skill in evaluating deals, but it might have just been luck. We won't really know until the future whether I've been so far I've been more fortunate than a lot of other investors, and I hope it stays that way. But we won't know until later. So maybe understanding the risk a little bit more, and the second thing would probably be just to recognize that I already have a good career, and there's no reason to try to switch to something else. Even though I never made that move, it was always one of those things like, oh, everybody does this in a couple of years. Not that I ever thought I would quit my job. More like they're going to start doing the deals themselves and become like a sponsor. And there are people that have W-2 jobs and still are general partners. I think it's very hard to do, but it is possible. So I thought that maybe one day I would do that too, and I realized I don't want a second job. So maybe I could have recognized that a little bit earlier and just focused on evaluating the risks a little bit better.
Awesome. Yeah, there's it's been a lot of fun talking to you about this. These are such good and important topics because just like the invest in LLC or personal, these are all like so many topics along the way of everything that you need to know to get started. And even the fundamentals are there for a reason. Like you can always master them more, right? So yeah, man, it's been a pleasure talking to you about this, Paul. I look forward to seeing you next time around. And I asked you this around last time we chatted, but what types of conversations do you like to have? Is there anything you for people that do want to reach out to get to know you? Is there some place they could reach out to you, and what do you want to talk about if they do?
Well, I'm happy to talk to people about investing. If somebody is either thinking of investing in real estate, I'm happy to talk about starting out. And if somebody is already doing this, I might even be more enthusiastic about sharing lessons learned with people that are serious about being a limited partner. I've suggested this earlier that like a lot of people I meet are the ones that even if they've never done their own deal, they want to do that. And I like the idea of just kind of becoming more of a professional investor. And those are the kind of people that I really want to talk to. Like, how have you done? How can we get better? How can we find better deals to invest in? How can we make more money? So new investors and experienced investors are the kind of people that I would love to have conversations with. I would say probably the best thing to do is email me, and you can probably post the address or when you share this, or it's my full name at yahoo.com. Happy to happy to get an email. I think that's probably the best way to reach me. You can find me on social media, but I don't really do a whole lot of real estate talk on there. Just because I'm not, I mean, a lot of people on there talking about real estate or marketing their businesses and stuff like that, and I don't have a business to sell. So, I mean, if you search for me, you're going to see me, but I won't be talking about real estate. So, I mean, you're probably better off just emailing me.
Perfect. Well, thank you, my friend.
All right.
So go find Paul if you're an experienced investor. You want to talk about more of the more in-depth stuff as well. And thank you for your time today.
All right. Thank you. Take care.
Thanks for joining us on another episode of Path to Passive. We love connecting with our listeners and those on the path to architecting their wealth and improving their lives. Feel free to let us know what topics you'd like to see in future episodes. Get in touch with us through email or Instagram. See you next week for a new episode.